for instance, like I've been seeing a lot of cash out refinances recently, just because a lot of like seasoned investors, they know right now is not the best time to invest or find new properties or opportunities. So they're kind of building up their cash reserves to kind of be ready once the market kind of opens up and opportunities.
You found the Real Estate Law Podcast, because real estate is more than just pretty pictures, and law goes well beyond the paperwork and courtroom arguments. If you're a real estate professional or looking to build real estate expertise, then welcome to the conversation and discover more at realestatelawpodcast.com.
Welcome to the Real Estate Law Podcast. I'm Jason Muth, and we're here with attorney broker Rory Gill from Next Home Titletown Real Estate.
Hey, Jason, good to see you.
Yes, excellent to see you too. We have a special guest this episode, and I will say that this guest absolutely is someone that beyond all the guests that we've had, I've known this guest longer than anyone else we've spoken to, because I've legitimately known this person since the first day of his life, because it's my younger cousin, Kyle Muth. Kyle, how are you?
Hey, I'm doing good. Thanks for having me on. I guess real estate runs in the family a little bit.
Yeah,
So.
I think so. I mean, like, my father, Uncle Ernie, he was a real estate agent for a long time and an appraiser for a long time. And I'm not licensed at all. I mean, like, you've known me forever. I've been in broadcasting, right? And media.
Yeah.
But Rory found his way into real estate law when he came out of law school, right?
Yeah, it took the long way. I started off as an attorney and then came back around, became a real estate broker, and grew from there.
And then I circled back in just by being an investor, so you and I have talked a little about the investments that we have. And, once we bought our first investment property 5-6 years ago at this point, like, you just get the bug and, you kind of take it from there. And then Rory opened Next Home a couple of years ago here in Boston. I should also say, Kyle, you went to Bentley for your undergrad or your grad degree, or both, right?
Undergrad, like corporate finance and accounting. So like a business degree, basically.
You're up here. I remember getting a phone call from your mother back around your senior year being like, hey, listen, like, we have, Kyle's going to the Super Bowl. We have an extra ticket. Like, do you want to go? No one else could take him. I think I was like way down the list of people that actually wanted to go, but like, I pieced the whole thing together. I don't know if you remember, but I mean, you obviously remember going to the Super Bowl, but like, I wrote her back or called her back. I'm like, yeah, I booked the whole trip. Like, I booked our airfare and hotel and everything using all this frequent flyer miles I had at the time. And she's like, oh my God, you're kidding. And I was like, you're kidding. I get to go to the Super Bowl. Like, I just got to hang out with Kyle for a couple of days.
And then you used all your broadcasting connections. We got into the WEEI party. I remember that.
We did. Yes. Yes.
Yeah.
And actually my job here in Boston works with the competitor of WEEI right now, 98.5 The Sports Hub. And I will say we're crushing them in the ratings and revenue right now. So, I mean, they're a great competitor. We all, poke fun at each other, but yeah, back at that Super Bowl, that was what, like 12 years ago? Giants, Pats.
Yeah.
That was the one where they went 18-1, and the Giants were the one in that one game. Yep. That was that was before loss. It was a big giant loss. That was before the Sports Hub was around. But we actually named Next Home Titletown after all the titles that Boston was winning for so long. And that's come to an abrupt end recently.
It sure has. It might be our fault.
Yeah, well, I know that all too well, just because when I was up at Bentley, the Red Sox won their first 2 titles ever. So that was pretty depressing coming from a New Yorker up in Boston freshman year, and they're burning down the green space because they just won the title. So it's
you remember that? Yeah. I mean, Red Sox, Yankees, that was fever pitched. And then the Red Sox started winning World Series. And then it's more just like, Red Sox, Yankees.
Yeah. They were down 3-0 to the Yankees. And then the first time that's ever happened. And then they finish it off in the series. So pretty
That
crazy.
3-0, I remember I was flying out to LA for a business trip that week. I was working with some stations out in Los Angeles, like all arrogant as can be. I literally wore my Yankee hat to the airport after they went up 3-0, assuming they were going to like clinch it like while I was gone. And not only did they not clinch it while I was gone for the entire week, but they lost that series. I mean, it's like clear as day. So we're not talking about Boston and New York sports today, although, we could probably talk about the entire episode, but we're going to talk about real estate. Kyle's got a great business going on called Muth Capital. And I know I pronounced it correctly because my last name also is Muth, but you must get it like me. Like people can't say our name.
No, it should be like, they should put like a Y and an O in there to like make it more like suitable to the way it's pronounced. But Muth, I get that a lot. But
Mirth, do you get Mirth or Math?
Yeah, sometimes. I wasn't creative enough to come up with a better business name, so kind of had to go with what I know best, and that's my name. So it's kind of that's how it all worked out. Probably if I was more creative, it would have been something else. But short, to the point, looks professional. You just have people leaving you messages that they just can't pronounce the name too well. But anyway.
You're one of the few people in the world that could directly sympathize with what I go through. And Rory, you have no idea.
I'm Corey Roy. I think I kind of get the gist of it.
Yeah. Well, actually, my mother's called you Corey before because she
still does, but it's okay.
Okay, so Kyle, tell us about Muth Capital. Like, I know that you're talking to us on the Real Estate Law podcast, so there must be some connection to real estate. So, what are you up to these days? Why'd you start the business? What are you working on? What have you seen a lot lately?
Yeah, so I've always had kind of an entrepreneurial spirit, but kind of my background kind of went into the corporate side of things, where working with mutual funds, and then also I was at Ernst & Young doing credit advisory for large banks and other financial institutions that may have an impact on the whole U.S. economy. So this was right around the time of Dodd-Frank. They had to figure out the processes behind their risk profiles. To be honest, the corporate life wasn't like fulfilling me to a point where I wanted to take that to the next level, go on the partner track or move around to different corporate companies. And also that kind of gave me the idea of wanting to help the people that maybe are too risky for the banks to lend to. So that kind of started thinking about, okay, there has to be alternative sources of capital for both businesses and real estate investors out there, that because there's great companies, great individuals that are doing investments or gaining traction with their portfolios, but they do need other sources of capital to kind of get to the next level or keep growing their businesses. So kind of went into it as like a loan broker, kind of connecting capital for businesses and real estate investors. And that kind of turned into becoming a hard money lender myself, where I'm originating the loans. I have a fund that's behind me now, and that's kind of where we're at. And that's the bulk of the business, which is fix and flip loans, rental property loans, commercial property loans. You name it, we could figure it out. If the property needs some rehab or needs to be leased up, you need to get some tenants in there to get to the true market value of the property. There's short-term loans to do that. And then there's also your long-term 25, 30-year amortization, rental property, multifamily type of loans that are very similar to what the banks offer for real estate investors and commercial property owners.
So pretty much if we bring it, you can finance it.
Yeah. And even if it's not through the fund that I have behind me, it can be done because there's so many different connections that I have to different lenders in the space that have a niche that typically can be financed, or they like certain properties versus others, or different like lending structures. And depending on what's needed for the client, I try to think that I can get that done for the client.
How do you start a business like this? Like a couple of years ago when you decided that this is what you wanted to do, like what's the first thing you do besides incorporate?
First thing I did was kind of start researching different lending companies, because you can't get clients until you have the money to kind of to lend it out or to connect the client to. So that was the first step. And then you start gaining momentum in that sense, and kind of it goes on a deal by deal basis. So once you start the marketing, the website, incorporating, and deals or clients start to come in through networking, through social media, through anything like that, then you see what's actually needed in the market. And then basically what I did, I was like, okay, I'll go find it. Like, that's kind of how I started. And then that grew into, okay, multiple people are looking for similar types of lending. So let's try to kind of put something behind that and potentially become a lender myself through the relationships I've made and the loans that I've helped originate in the past.
So Rory, have you worked with lenders similar to Muth Capital and what Kyle's doing?
I haven't. It's been it's sort of a spotty record and inconsistent across time. So when you're thinking about consumer facing loan products, there are a lot of lenders who are very similar, and how you differentiate yourself is how well you treat the client, the customer service experience from beginning to end. Otherwise, a lot of the loan products are pretty similar in terms of their qualifications, rates, and terms. But this space, kind of the specialized loan world, is very inconsistent. And there are a lot of different ways where people can distinguish themselves and stand out. But we've had very, inconsistent experiences with these products across the board. Is that a fair way to characterize the marketplace for this? Is it kind of just scattershot across the whole world?
Yeah, so there is some uniformity, like with your traditional hard money lenders, where it's fix and flips terms. So typically 12 months interest only. You get a certain percentage. They'll lend a certain percentage of the purchase price, and then typically 100% of the rehab cost through construction draws, and that's based on an after repair value. So after repair value is what the property could be worth with the rehab that is going into the property to get it to market rates within that community. So say a house hasn't been updated for 20 years, and the homeowner has just passed away or something. They're kind of an older person, and basically the house is just stuck in the 1980s or 1970s with appliances and rugs and paint, and kind of it just needs a quick update. So that's what these kind of products are there for. And basically, and then the rental property loans are pretty standard as well. That's more of a newer product, just because typically hard money lenders, they want to get in and out quickly with the borrower. So those are to be very quick loans. This is more your typical 30-year product. But the big thing with these hard money lenders, and we only can do business loans. So you have to put property in an LLC or different organization. It cannot be in your personal name. So it's not a consumer product. It's a business lending product.
So you're working with, obviously you like long-term clients, because if you get somebody that has a great experience, they want to do more of these, then hopefully they'll do them with you. But do you also find new investors, somebody that says, hey, my friends are doing real estate investing. I want to do real estate investing. I want to flip a house, but I don't know where to begin. That's a customer you could take on, right? I mean, they put it into an LLC and then off you go.
Yeah. And the big thing with those clients, I mean, I see a lot of them, basically they're your like bigger pockets, or like RIA. They go to these RIA events in all these different communities with like-minded people that are interested in real estate but haven't pulled the trigger themselves yet. And a lot of times they they're nervous to jump in, but it can be stressful. Obviously, it's probably the biggest investment of their lives up to that point. And we kind of can hold their hands through that process. It can be definitely stressful, but also if you come into it with a sound mind, okay, this is what I'm going to spend. I'm not going over my budget. The numbers don't work at this price, so I'm not bidding above what the numbers work at. So those are types of things that can help a new investor just kind of stay on track. And then also having a great team behind you, like having a great broker like Rory, having a great real estate attorney, having a decent accountant to figure out the numbers. And then also having a licensed GC is probably, I would suggest that being the most important part of doing a flip yourself, because numbers can get, with the way material costs are and you not being in kind of the weeds, that can get pretty dicey. Especially we saw lumber prices at like an all-time high a few months ago, and that can make your budget explode if you didn't factor it in. So
add 30, 40,000 to it.
In this past year, with kind of all these, supply side problems and even just having a difficult time finding good licensed general contractors that are available, has the market for these fix and flip loans become stronger or weaker, like during this unusual year?
So I'm not sure about what the market's like in Boston, but around here in New York, just the way home prices have skyrocketed because of the easy access to like cheap money on the market. And then also you have all these cash buyers coming out of the woodwork. It kind of dried up the investment property strategy, because these homes that needed to be updated, they're going for 30 to 50K over what the actual as is value is currently. So and pretty much in New York, it was crazy because with COVID and everything, just everyone was just like, I got to get out of the city. Like I have to move away and just get out of there. So that's kind of what made all the like suburbs around New York City just explode with people looking for properties. But also, like you said, the supply side is there. It's pretty barren at this point. So that skyrocketed the prices for these properties.
I mean, we're seeing similar trends here. So, my concern in this, the type of investor who is a new investor who is trying to get into their first project, who's just putting their team together. A lot of them are shut out of kind of the traditional investing model that we've been, promoting for a few decades, where you buy a property, find a property that's distressed, go and put the elbow grease and the work into it. You'll have instant equity for the property, which allows you to refinance it, rent it out, and continue on. A lot of those entry-level investors, I've been having a hard time setting them up with a good investment plan. So for somebody in that situation, do you have advice or encouragement?
I think the market is going to get a lot more favorable for them. Right now, it is a tough situation just with the supply side. And then also, actually, there's a few factors like the moratoriums in place. So like foreclosures and evictions and everything like that, that doesn't help things in creating these distressed properties. Everything is pretty much priced at not distressed, at pretty much at the top of the market. And you only have those consumers that will be able to, or that will purchase those, because there's no additional value that can be added at that point, at that price point. But with the moratoriums ending, rates going to be ticking up in the next couple years. That will kind of cool the market a little bit and create those value add properties that should be coming to the market. For instance, like I've been seeing a lot of cash out refinances recently. Just because a lot of like seasoned investors, they know right now is not the best time to invest. or find new properties or opportunities. So they're kind of building up their cash reserves to kind of be ready once the market kind of opens up and opportunities start coming their way. And I am seeing more investors coming back to the table, like pretty much recently. So third Q3 this year is when I started seeing an uptick, well, back to like what I used to see, but pre-pandemic.
Okay. Are you seeing anything on the supply side improving near you?
A little bit here and there, but it's a slow burn. It's not gonna like just open up like crazy right away. But because with the Delta variant and everything else going on, and potentially more shutdowns, restrictions, things like that, that demand will still be there. I think it might even increase in Q1 potentially of 2022, and hopefully it kind of dies down after that. But who knows? It's a crazy world we're living in right now. So
I know the only thing that's certain is uncertainty. I mean, we've had a bit of a slingshot here in Boston, where Rory and I talk about this all the time. You know, a lot of people fled the city, just like in New York. I mean, there's a whole lot more people in New York City than in Boston, but Boston is still a big city, and there was nowhere for them to go in the suburbs. You know, so everything got bid up. I mean, Rory did open houses through this period, and you know, he'd have a table outside and a line down the street, pretty common. But you know, it could be like area dependent too. I mean, like there's inventory in the city. You know, it's not an overabundance of inventory, but there are some pockets of the city where things are sitting and some where things are moving fast. You know, I do think people are still navigating. Are they going back to their office at all or not? And I think companies are still trying to figure that out, because a lot of companies around here have delayed their return to the office, and others have been open all along. You know, like my job, you know, it's a bit of a hybrid. Like we never fully closed, but like we thinned the office out many times over the past 18 months as things spiked. So right now we're back in variance, but you know, that might change again around the holidays. Who knows? And I think that the real estate market also is going to fluctuate as people determine if they really do want to stay in, you know, tight urban areas for longer periods of time.
And talking to like commercial brokers, they're seeing an uptick in or in business in the suburbs. So like opening, like companies that want to open up satellite offices that employees don't have to go all the way to the city anymore. They've found that they can do their job from an office closer to home potentially, rather than do that commute. And I know a lot of people probably don't want to commute, use the trains or Metro North down here, but the T up there. So they kind of want to be very close to home. They got a taste of what it's like to kind of have more freedom around where they work. I think that's a big thing for a lot of people, at least around my age now. Like none of my friends want to go back into the city or go back to the office. They're dreading the day that the company is going to make them come back. So, but hybrid plans, I think, are here to stay, just with the increase in technology, use of Zoom, use of video calls. I think it's all like, it just exploded, and it showed people that maybe they can work from home. But it also, like, because all these companies, they want company culture, they want everything to kind of push the culture in their vision, and that's a lot tougher doing it from home. So you might need a hybrid approach where you do have people in the office so that they can kind of work together or kind of bond in a workplace setting, because it is harder to kind of bond on a video call, I feel. So
absolutely, you said it. I mean, hybrid is going nowhere. You know, I'm a little bit older than you. And, we don't want to be back full time either to the office. Like the people that want people back full time to the office are the C-suite folks. And, my job, I think, is doing better this year than some of our local competitors because we did go back a little sooner, like safely, but we went back a little sooner. But having flexibility also is really what's going to be going on in the near future. And people that are in their, late 20s, early 30s, I know people around here kind of start families a little bit later in Boston. They establish their careers. They have some fun in the city. They pair up. They, have their kids in the city. Then they move outside the city after the first or second kid. Rinse, repeat. It's like you could predict the formula. I think that a lot of those folks are realizing, that they're getting into first-time home buyer space now. And if their mindset is they want a hybrid environment, that's going to dictate the market. I mean, it is a very strong job market for job seekers right now. I don't know if it's like that around New York, but in Boston, man, like you could post a job and it could be tough to find people. And people, if you're looking for a job, you could have demands of your employer that you couldn't make 2 years ago, or even when everything started shutting down, when everyone got laid off, or a lot of people got laid off. It's very different now. So anyway, let's talk a little bit about some of the more interesting loan products that you've seen lately. I know you and I have talked a little bit about some of the short-term rentals that Rory and I have. And I talk about that on this podcast a lot because it's kind of my, like I could relate to this experience. And it's been a banner year for us, like with our short-term rentals, like legitimately up, a significant double-digit percentage versus last year, which was admittedly a down year. But even when you compare to 2019, they're still up because the demand to get out of the city or get somewhere, in the country. And one of our places is in Provincetown, and that one just killed it this year. But the other one is in New Hampshire, and like everyone wants to go up there. But you're right. They all want to ask about internet speed. I mean, I get that question a lot. Like, how fast is internet going to be working from there? So talk about some of the short-term rentals and some of the other interesting, products that you've done lately.
Yeah. So basically the alternative credit market has kind of came back with a fury, like with both the rental properties and now short-term rental. Like they're finally have a gauge on like projecting rents and kind of projecting like debt service coverage ratios with these types of properties, because there's so much market data out there for these properties, because everything's tracked with Airbnb and was it VRBO. So you know exactly like kind of, all right, a similar spot in the same town, you're having 61% projected days used or weeks used or something like that. And then you can project out the yearly income from that property now. So lenders have gotten a lot more comfortable with those, because that wasn't the case before. And in many situations, you're seeing higher rents than your long-term tenants would pay traditionally for that same property or single family rental. That's gotten us pretty comfortable. So now we can go up to 75-80% of LTV based off of the projected rents from these types of properties that are going to be used for short-term rentals. So that's great in a sense, because you're giving yourself it's a new avenue for investors to kind of come in, and they don't need that traditional the BRRRR method, but now it's with short-term rentals rather than just long-term tenants that sometimes are maybe difficult to deal with. So short-term rentals, one good thing is that people don't stay that long. They're staying a week, a couple weeks, and then they're getting out of there. Maybe you have a little bit of damage or something like that, but that's all kind of factored in to that model, or that should be at least into your kind of budget and everything like that. I know you guys probably factor that in pretty significantly with all the numbers that you guys do for these properties.
You answered my question that I was my follow-up question that, why would lenders be so afraid of these short-term rentals? But I guess it was the lack of market data that was out there in the beginning, because for a while it felt as though commercial lenders were demanding that you take a less profitable approach to the property and do long-term rentals, even though short-term rentals would command quite a bit more. So I'm happy to see that there's been movement in that space with the alternative lenders.
Yeah. And you'd be surprised. I mean, like the damage isn't as bad, like knock wood, at least for us, it's because the place is getting cleaned constantly. It's not like you have a renter in there for 12 months and you have to realize how disgusting it was after they left acrimoniously or harmoniously. Short-term renters usually have a decent experience because they're there for a couple of days. It's different. They're in town for a reason, to relax, for a wedding, bachelor party, whatever. You deal with like different kind of issues. Like, today, for example, I dealt with somebody who left his suit at the house and apparently a box with a monitor in it. I'm like, okay. You get a phone call saying, is this the person that owns this property? I'm like, yeah, I stayed there this weekend. I left this there. Like, do you mind if I go get it? I'm like, yeah, that's no problem. Like, what's your name? And he told me, I'm like, well, you weren't on the rental. So let me just confirm with the person that rented it that I should be giving you the code to the house. And then everything checked out. But, it's some logistics you have to deal with, but it's not a big deal compared to like how much money you get with these short-term rentals. And yes, if you do it correctly, it should gross you, not necessarily net, but it should gross you a lot more than a long-term rental. There's more expenses involved, but it should gross you a lot more.
That obviously has to be factored in on the investor side of things because one, you have to furnish the property, and then also the management fees, the cleaning fees, everything else that you have to kind of have in place for it to be successful, so that those expenses can add up pretty quickly if you don't kind of take a more shrewd approach to those kind of necessary line items in your P&L.
Yep. Utilities, cable, internet, oil, propane, everything. Mm-hmm. Yeah, we do that all. Carpet cleaner. I bought a carpet cleaner. Those machines that you could rent at Home Depot. Like, no, I own one now because I needed to make sure that. I got a big green machine or whatever it was, a Dirt Devil. It's actually fantastic. If you need to borrow it, you got to drive to New Hampshire, but I will lend it to you.
Yeah.
Rory, go ahead. I see.
I just wanted to move on. I see that Kyle worked to help secure bridge funding to an interstate cannabis company. And that catches my attention because of all the different moving parts that are in there. Because I know my title underwriter, my insurance company, and other third-party providers would never let me touch a project like that for a host of reasons. So, it being the Real Estate Law Podcast, it grabs my attention because there are just so many moving parts and obstacles to overcome to get any funding there, but we have cannabis industry, multi-state, short-term bridge funding. So tell me about that story.
So knock on wood, that's something I'm working on right now. So it hasn't been secured yet, but it has opened up the doors to a lot of different niche, like alternative lenders and like equity investors that are starting to look in the cannabis investment space. And since you can't cross state lines with THC products, you pretty much have to have licenses in each state to actually operate, manufacture, cultivate like the cannabis that's needed to be sold in that state or put into products like your edibles, your vape pens, your
gummies.
And as states open up, like these licenses are pretty much golden. So this company is taking kind of more of a like operational approach that their team is they've all like operated, some in the cannabis space, but others just running your traditional manufacturing companies. And they're kind of partnering up with all these different properties that have these licenses. And now some of these states they're not giving out any more licenses. So the property value increases based on the licenses being in place for that location. So basically, we're knock on wood, I'm talking with a few different lenders that would lend off of the property value of these, having this property with licenses in place, and it's pretty interesting. So that's kind of like sometimes you get these clients or these files that come across your desk, and you're like, oh, that's interesting, I've never even heard of this. But then you take a deeper dive, and that's kind of what I like about just lending in general. It's a different story every time, and you kind of are starting to see, oh, there's so many different potential ways to make money. And if you want to, if you have a great idea and can secure that funding, then you're in a good spot, and you could potentially just have a great wealth created entity for yourself, or sell, like, you build it up, you sell it to a big time player or private equity fund, and you rinse and repeat, kind of like rental properties.
There's a lot of money to be made in the cannabis space. There's a lot of money being spent in that space. We've actually started taking advertising for cannabis, and we run some digital marketing campaigns in the space where we're allowed to, like Facebook, Google. They still won't take advertising, but they have money to spend. I mean, and not that we gouge them or anything, but there is a little bit more risk involved, and more legal eyes, and attorneys are not cheap, as Rory can attest. But yeah, it's smart to kind of focus in on that if you're able to. And I think that there's a lot of businesses that are looking to figure out how can they work in the cannabis space legally and grow their business. And the first movers are going to be the ones with the big advantages, is my opinion.
Yeah. And basically all of it's essentially private money right now that's in the space, because banks can't touch this stuff yet if they're FDIC insured. So it's all private money or funds out there that are getting into it. Some funds are less risky. They'll only invest in companies that don't actually touch the plant. So it could be helping with the logistics side of things. It could be helping with security. It could be okay, I'll invest in someone that would own the property, but they're not operating the business. So they're leasing it to the cannabis operators in the building. So a lot of different ways to go about it. Some are riskier, and they'll just be like, hey, we'll invest in the whole thing, because we see the future value in kind of investing in the space and taking the whole risk with the THC and the CBD and everything. So if you're looking for
if you're in the cannabis space listening to this and you're looking for some funding, Kyle obviously knows what he's talking about here. He's done some of his homework. So we'll get all your information at the end of this podcast and put in the show notes, but awesome. Definitely reach out to him for any kind of financing in that space or anything else. But tell us about a couple of the trends that you're seeing these days, besides, boatloads of money going into the cannabis space.
Yeah. So, basically, with all the government assistance out there for businesses and individuals, and a lot of it coming from or being originated from banks, they're a lot slower coming back to the commercial lending space, or they're taking a lot more conservative approach, whether that's with your mixed use or owner occupied properties, or even multifamily properties. They're offering potentially less LTV, so you have to come in with more down to get into these properties or invest in these properties, or they're just kind of shying away from the deals. They're not really kind of being aggressive with their lending currently. So, and I ran into a situation where a client had a loan commitment for 75% LTV, and basically the bank moved the goalposts and offered them 55% LTV, which that's a big chunk for a commercial property to come up with that at the last minute. when you already had a commitment for 75% and closing was going to be within a month of that. So we were able to get them a bridge loan just to kind of purchase the property, and then eventually they'll refinance through a bank or through another conventional lender that will give them the kind of, if it's not a bank rate, close to a bank rate for that for that property.
How long is the bridge loan for? 12 months?
12 months. And sometimes there's different, in the commercial space, sometimes there's different like things that would be needed, like a guarantee of 2 or 3 months of interest payments. So sometimes commercial lenders, they need to make a certain amount in the interest because of their investors' mandates on what they can kind of lend out and what the return, the required return should be on those lending facilities.
Mm-hmm. So before we head over to our final wrap up, I just wanted to see what's the future hold for Muth Capital? Like what are you working on for the rest of the year and into next year?
So during the whole pandemic and everything, I updated my website, my social media, my blog posts, and kind of what I'm doing right now is trying to reconnect with strategic partners that I've kind of tried to cultivate before COVID hit. So this is like 2019, like people that I've run into. So I'm kind of trying to reach back out to them, see what they're doing, see how business is going for them, whether that's in the real estate space or some other business that they're into. And yeah, it's just kind of reconnecting with people. Started doing that a little bit each quarter this year, but keeping it going, keeping the momentum going is what I'm focused on right now, going into Q4 and then 2022.
Yeah. I mean, I think there's kind of a lost year and a half or 2 years in there. You know, we happen to have a baby during it. So, you know, we kind of have we have both the baby haze and the COVID haze going on. But, you know, you look back 2 years ago and like there are some people that we've run into or that we see that you haven't seen since before COVID and before the baby. And you're like, God, I haven't seen you in 3 years. You know, like Rory and I just went to a concert last week for the first time here in Boston in
almost 3 years.
Almost 3 years.
Wow.
Yeah. And I mean, you know, Kyle, you know me, I used to work I worked in radio. I was at so many shows my whole life. Like, you know, it was an ongoing thing. I mean, Rory, we probably been to more concerts than you'd ever been to before, you know, we started going to shows together. And yeah, it was just like party every day. And then all of a sudden it's gone. And then we were just standing at the, it's called Leader Bank Pavilion now, but it used to be called Harbor Lights here in Boston. We were at a show last week, just like, man, I haven't been here in 3 years. It feels like yesterday, but that was 3 years.
Yeah.
This whole reconnecting thing. Yeah.
Well, like Giant games for me. I mean, like you go from no fans, you're tailgating. There's 80,000 people in the stadium, and it's wild being back, but definitely missed it. So going to the games, going and tailgate and everything like that, and and you didn't see like I didn't see like Steven for a while. Steven Leitner, like he like didn't see him before COVID.
Because you saw him there at the games, and that's when you saw him, right?
Yeah,
But you know, the one thing that's consistent, the Giants continue to find a way to disappoint everybody. You know, like game and time and time again. Yes,
they're finding new ways to kind of
new ways to lose.
Yeah,
I mean, who they play in week 2? Where I literally said that to Rory, like, you know, with that false start with the field goal that was wide, and then you give them 5 more yards and you make it, you lose the game. Like, wow, they found yet another way to lose.
And the replay that wasn't offsides, but
well, you know, what are you gonna do? I mean, it's a comedy of errors.
another lost season. So
just enjoy the tailgate, right?
Yeah, I guess I'm hoping hockey comes back soon, so I'll get to watch that. So
you know that I was gonna ask you about that as part of the final wrap up. I mean, so we'll do that right now. We asked the same three questions of all the guests that are on the podcast, just to kind of, lighten it up a little bit as we conclude. But the first question is, if you can get on stage for 30 minutes and talk about one subject with zero preparation, what would it be? Like, I was thinking it would be hockey for you, but what's your answer?
It could be hockey, but it'd probably be the New York Giants. It'd be a depressing presentation, but I could probably talk for 30 minutes on how they've broken my heart last few years.
Yeah,
since the boat trip in 2016, I could probably talk a lot in detail about that.
I mean, they've had a good run as a franchise, though. All right. And, I always say I love the Pats also. I mean, I'm a big Patriots fan living up here for so long, but, the Giants are my number one team. And and Rory could attest to this, when the Giants play the Patriots, I cheer for the Giants. It's the only time I cheer against the Pats.
And it's the only time we see them win, unfortunately.
Right. No, it has to be the Super Bowl. So any other time the Patriots win, except for the Super Bowl.
Yep.
But yeah, all right. So really depressing 30-minute discussion. But you'd have a lot of people in the audience sympathizing with what you say about the New York Giants.
Yeah. If they don't want to get angry, yeah.
All right. So we'll go really quickly at number 2. What's something that happened early on in your life or your career that impacted the way you work today?
Well, basically, I came out of school during 2008, so basically that whole situation. So I've been through 2 kind of economic shutdowns in my life, but also just the fact that that was a big impact. And then kind of going into a more safer career at Ernst & Young, I was like, all right, I need to take a risk and kind of jump in with both feet to kind of doing my own thing and figuring out how I want to live my life and my career. So that kind of made me, got me motivated, I guess, to kind of do my own thing, because there's probably going to be another economic shutdown. And I don't know it's coming, every 10 years or something like
cycle,
that.
Right.
Yeah. So that definitely impacted me tremendously, just kind of how I want to work. You don't have to, I realized you don't have to take that W-2 paycheck there. You could create something for yourself, which a lot of people are nervous to do, but also a lot of people don't think that way, or they don't know that they can do that. So if they really hate their job or something, there's other ways to kind of make money than on that corporate grind, I guess. So
yeah, that's great advice to heed. And Rory could sympathize. He graduated law school into that same down economy and started a business.
No W-2s in my recent past.
Yeah.
Finally, what are you watching, reading, or listening to these days?
Yeah, so I've been watching wise, obviously I've been through every single show on Netflix during COVID, and but one thing that's pretty cool is the new Wu-Tang Clan show. It's actually really, really good. I recommend it. It's on Hulu.
Okay. We'll have to check that out. Do they have the Wu-Tang Clan members on the show?
No, so they have actors. So it's actually a whole, they have different seasons. It's kind of like your traditional show structure, Sopranos, The Wire, those types of things. So it's pretty cool.
With less murder?
Yeah, more rap and music. Yeah. but still showing some coming up in Staten Island, so it's pretty cool. And then reading wise, I'm big into kind of those historical, either something in the early 1900s, with Industrial Revolution or World War II. On my reading list, I have a Churchill book that I'm going to start after this book called The Tycoons, which goes through J.P. Morgan, Rockefeller, Carnegie, and Jay Gould, how they created pretty much the U.S. super economy back in that time period. And that's very, very interesting And then also I recently read Billionaire Whale. It's about the Malaysian 1MDB fund scandal, like with this guy, Joe Low, who pretty much scammed all of Malaysia out of, I think it was like $6 billion or something like that. And there's a ton of like documentaries on it and stuff like that, but the book's really, really good. And yeah, and then next, another one is the American Kingpin, the guy that created that Silk Road, the internet Silk Road, where you could buy anything you want. Like, yeah. So I'm into those types of whether it's like the early 1900s, or then these like true life, like financial, like crime type of books too, that are pretty interesting. And seeing how people like got away with it without any oversight, or just believing that if you deal with enough money, you just believe that they're good people instead of doing due diligence. So it's kind of interesting how that all works.
I can't wait to check some of those out between our Disney programming and CoComelon. So, Kyle, we need to wrap it up. Thank you so much for being on this podcast. The Real Estate Law Podcast really appreciates your being here. How can people find you? And we'll put it in the show notes.
Yeah, so obviously all over LinkedIn. LinkedIn's good. Facebook, my website, muthcapitalrealestate.com. It kind of goes through all the products that we can offer. And yeah, an email obviously is the best, Kyle@muthcapital.com. And yeah, we can get you a quote on any property you want within 2 hours. So it's with just a few like different questions, and we don't require financials or tax returns. So it's just 2 months bank statements. If you have the money to close and 6 months of reserves, you should be pretty good, and base it off of all the property's cash flow and market value. So it's less about the actual individual's financial picture. So, yeah.
And in 2 hours or less.
Yeah, you get a quote, and you can use that to strategize around how you're going to purchase the property, or how you're going to come up with the money to pay for the property.
Cool. Well, listen, I want you to come back on some other point, and we're going to dig deeper into some of these actual specific situations that you're seeing, because you're obviously a wealth of knowledge, and we'd love to have you on in future episodes as well. So you're going to be on my short list of being back on this podcast.
No, I appreciate you having me, Jason and Rory. I like what you guys are doing with this. I see the Instagram clips. So, and I got to start listening to future episodes too. So happy to come back on.
Back to episode number 1. It's an audio only episode of why we even do this in the first place. But there'll be many more to come. There's a bunch posted right now, and there's a little bit of something for everybody up on our YouTube page and our Instagram page. So thanks again. And Rory, by the way, where can we find you?
I'm easy to find. Just look for me at urbanvillagelegal.com or nexthometitletown.com.
All right. And once again, I'm Jason Muth for the Real Estate Law Podcast. And thank you so much for listening to this episode. Go support Kyle Muth and Muth Capital. Go support Rory Gale and all of his businesses, and keep listening to us. And we'll see you next time. Bye.
Thank you.
This has been the Real Estate Law Podcast. Because real estate is more than just pretty pictures, and law goes well beyond the paperwork and courtroom arguments. We're powered by Next Home Titletown, Greater Boston's progressive real estate brokerage. More at nexthometitletown.com. And Urban Village Legal, Massachusetts Real Estate Counsel, serving savvy property owners, lenders, and investors. More at urbanvillagelegal.com. Today's conversation was not legal advice, but we hope you found it entertaining and informative. Discover more at realestatelawpodcast.com. Thank you for listening.